let's suppose the money supply increases. So first, what would cause the money supply to increase? Well, option number 1 is we print more. Option number 2 is we lower the bank rate and the overnight target rate. Right? If we make it cheaper for banks to borrow money, then they're going to have more cash to lend out. So printing more, lowering the bank rate and overnight target rate. We can also do what to the target reserve ratio? Would you make it go up or down if you wanted to increase the money supply? Well, we make the target reserve ratio go down. Remember, the target reserve ratio is the amount that banks have to hold as cash. They can't lend out. So if you lower the target reserve ratio, then banks can lend out more of the money they have on hand. So increasing the money supply through bank lending. And the last way to increase the money supply is to do quantitative easing. Okay, so we can increase the money supply really in 4 ways. Print more, lower the bank rate and overnight target rate, lower the target reserve ratio, which I forgot to write the rest of the sentence out, so let's try that again. Lower the target reserve ratio. There we go. Or quantitative easing. Okay. So let's suppose we increase the money supply. Well, if we increase the money supply, then at the current interest rate, so here's where we are here, we now have, well, let's see, quantity supplied is more than quantity demanded, right? So we have what, a shortage or a surplus? We have a surplus of money. So there's more money, more cash on hand than we want to spend. If there's more cash on hand than we want to spend, how do we get rid of that surplus or extra cash? Well, we're going to take that money and we're going to want to put it into an account that would earn us interest, right? So that we can use money as a store of wealth. We want to be able to buy more in the future. We don't need this cash now. It's a surplus. We want to have it for later, and we'd like it to grow. So that means that we are going to need to get rid of our excess money by putting it into other forms, M2, M3, things that earn us interest. Well, if we look at the bond market, for example, we would buy bonds. So here's demand for bonds, here's supply of bonds. If we're taking our cash and we're going to buy bonds, the demand for bonds goes up, so demand increases. The price of bonds then does what? It goes up. And we know that since bonds have a fixed value at maturity, if the price of bonds go up, then the rate of return on those investments, like bonds, will do what? They'll go down. And so what happens is when the money supply increases, interest rates go down. And so we start here at equilibrium where money supply and money demand intersect. That increase in the money supply created a surplus of money. And so we put our M1 elsewhere in things that earn us interest. And that increased the demand for those, which pushed down the interest rate. So the interest rates fall when the money supply increases. So because of this, the Bank of Canada can't set the prime rate. They can't set the rate of return on bonds and other investments. You can change the money supply or you can change interest rates. You can't change both. So when the Bank of Canada changes the bank rate and the overnight target rate, those two interest rates, they are changing the money supply. And when they print more or they use quantitative easing to create electronic money, it's going to have an impact on interest rates. The two are tied together. You can't change money supply and interest rates. If you change one, it changes the other. Now, what happens if there's a change in demand for money? So what if the demand for money increases. So then we have to think back, what changes the demand for money? What would cause this demand graph to shift to the right? Well, we have to think back to the different types of demand. Remember, we have asset demand, and what was the other one? Transaction demand. So we got to think about, okay, what would change our demand for money? What would shift this graph? Well, a change in the interest rates doesn't shift the graph, right? We're simply moving along the curve. But what does shift the graph is if prices go up, or if real GDP, that is our income, goes up. So if the economy grows, we have more money, we want to spend it as cash. If goods are more expensive at the grocery store, we're going to need more cash. So we're looking here at M1 and what would cause us to demand more money in terms of money in our checking account or in terms of banknotes and coins. So let's say there's a demand for money, that the demand for money increases, either because prices have gone up or because the economy is growing and we're all making more money. Well, if the demand for money increases, what happens? Well, at the current interest rate, so here we are at the current interest rate, and because of that increase in demand for money, the quantity demanded is now more than the quantity supplied. Okay. So if we want more cash than there is, we have a shortage. So there's not enough cash. And if there's not enough cash, then what we have to do is we have to start liquidating our investments. So we need to take money that we have tied up in mutual funds and bonds, money that's in our savings account, and we start converting it into M1 so that we can spend it. So if we're looking at the bond market, we're going to sell bonds, turn them into cash. And of course, we have the bond market, demand, supply. And so if we all sell off our bonds, the supply increases, which causes the price of bonds to fall. And since bonds have a fixed value at maturity, when the price of bonds goes down, the interest rate that they earn goes up. So if there's not enough cash for us to buy the things we need, then we're going to start liquidating our investments. Stocks, bonds, we're going to move money from our savings account, and when we pull all that money out now as cash, then that's going to actually drive up interest rates. If you think about it this way, a company who is trying to finance their debt, so they issue a bond and they're trying to get people to lend them money. How do you get people to lend you money? Well, if you get people to lend you money by raising interest rates. If we're all selling our bonds, then nobody's investing, right? Nobody wants to buy your bond. So how do you entice people? Well, you have to raise the interest rate. And so when we sell bonds, interest rates go up, which means when the demand for money increases, interest rates will go up. And you can see here, we end up at this higher interest rate. So we can look at what happens to the money supply or what happens to money demanded when there's a change. So we found that when the money supply increased, interest rates went down. We could go the other direction and look at what if money supply decreased. Then there's a shortage of money, we sell bonds, so if the money supply decreases, what happens to interest rates? They go up. And we looked at the demand for money. When the demand for money increased, it created a shortage of cash. We sold our bonds. That drove up the interest rate. So when the demand for money increased, interest rates went up. We could also go the other direction and look at what happens to the demand for money, or what happens when the demand for money decreases. I would shift the graph to the other direction. we have a surplus of cash. We have a surplus of cash, we buy bonds, and that makes interest rates go down. So now let's use this to help us understand monetary policy. So I could actually create a page here. And let's look at what is called expansionary monetary policy. Okay, let's actually draw 3 graphs. I almost have 3 graphs here. The first one is going to be the money market. So we'll have our money supply and our money demanded. So interest rates are on the vertical, quantity of money is on the horizontal. Then we're going to have a second graph, and we're going to have interest rates on the vertical and quantity of investment spending on the horizontal. Then we're going to have our aggregate demand and aggregate supply on the last graph, where we have our prices and our real GDP. Okay. All right, so expansionary monetary policy. Expansionary monetary policy means that the money supply is increasing. So let's increase our money supply, and that's a shift to the right. And we know that when we increase the money supply, what happens to interest rates? Okay, according to our graph, we go from here, we'll call it I1, to here, I2. And we know this happens because that increase in money supply means that the quantity supplied is now more than the quantity demanded. We have more cash than we need, so we're going to buy bonds, and that's going to drive down our interest rates. So the interest rate goes down. When interest rates go down, so we go from I1 to I2, what does that do to investment spending? Well, when interest rates are high, then investment spending, and remember investment spending is when businesses buy from other businesses. So what does that include? That includes capital goods, inventory, residential structures, and non-residential structures. If interest rates are high, then it's very costly for businesses to borrow. So the quantity of investment spending is going to be low. When interest rates are low, then it's cheaper for a business to borrow, and the quantity of investment spending is going to be higher. So if we want to graph investment spending as it relates to the interest rate, we get this downward sloping curve here. So interest rates go down, the quantity of investment spending goes up. Well, and that brings us to aggregate demand and aggregate supply. If investment spending increases, so businesses are buying more capital goods, more inventory, they're buying a second location, is that changing aggregate demand or aggregate supply? Well, if you recall, aggregate supply, there are 5 things that change aggregate supply. The cost of your factors of production, technology, capital goods, natural resources, and the quantity and quality of your labor. So this is making the goods. When we talk about investment spending, we're talking about businesses buying things. Remember, aggregate demand comes from aggregate expenditures, C plus I plus G plus X minus IM. So if businesses are buying more things, then aggregate demand will increase. And if aggregate demand increases, then our equilibrium goes from here to here. So the price goes up and real GDP increases. So by increasing the money supply, we can grow the economy and help increase prices or create inflation. So when might you want to use expansionary monetary policy? Well, if your economy is contracting, you're in a recession, then you can increase the money supply to grow the economy and get out of the recession. So let's look at contractionary monetary policy. Let's create a new blank page here. Oops. So let's look at contractionary. Monetary policy. Again, we're going to need 3 graphs. The first one is going to be our money markets, so money supply, money demanded, interest rates on the vertical, quantity of money on the horizontal. The second is going to be quantity of investment spending as it relates to interest rates. And then the last graph is going to be our aggregate demand and aggregate supply. And so we're looking at real GDP. So with contractionary monetary policy, we decrease the money supply. So if we decrease the money supply, that's a shift to the left. And a decrease in money supply means that at the original interest rate, call it I1, we now have a shortage of money, because the quantity demanded is more than the quantity supplied. So there's a shortage of cash, and if there's a shortage of cash, we start liquidating our investments. So we're going to sell our bonds and mutual funds and pull money out of the savings account. And when we do that, it's going to cause interest rates to go up. Okay, to a point here we'll call I2. And so when those interest rates go up, I1 to I2, what impact does that have on investment spending? Well, when interest rates are low, businesses are more likely to borrow. So there's a higher quantity of investment spending. When interest rates are low, it's more expensive for the business to borrow. So the quantity of investment spending is going to be lower. So when interest rates go up, investment spending goes down. If investment spending goes down, then does that impact aggregate demand or aggregate supply? Well, remember, this is businesses buying from other businesses, so it's going to decrease aggregate demand. Okay. And when you decrease aggregate demand, so if we're buying less things, then that's going to make prices fall, and that is going to make real GDP decrease. So contractionary monetary policy, when would you use it? Well, you would use contractionary monetary policy if you wanted to slow down an economy that was growing too fast. So maybe you have too much inflation in your economy and you want to push those prices down a bit. And if you decrease the amount of cash in circulation, that's less money in our pockets to spend. Aggregate demand decreases. That makes the prices fall and makes the economy shrink just a bit. So we're contracting an economy that's growing too fast.